Hello, fellow traders. In my last YouTube post, I shared a clickbait type of title that anyone who trades knows is ridiculous. Take 2,500 to 800,000, hypothetical, or 400,000. Completely ridiculous, right? And so I wasn't happy with my work. I wanted to revise that work and see, come up with something ridiculous, but a little less ridiculous. So we'll talk about that. And I think you'd be interested in this analysis if you're curious about it. But before we do that, please read this risk disclaimer. Futures trading is risky. And of course, we're just talking about hypothetical stuff. It's completely conjecture. I don't know that I'm required to provide this type of disclaimer given how speculative what we're talking about is, but it's good information nonetheless. One moment as I pull up the spreadsheet. So in the previous example, I assume you made a constant return of 3% per day, every trading day of the year. And we know you're going to have losing days. So I wanted to see what it would look like if we look at losing and winning days. And so what I've done here is I've configured this so that your risk is 3% and your win and loss is about equal, but you manage to win 70% of the days. That's like having 6 losing days out of the month and 14 winning days. Your net P&L in that case is $600 according to this, assuming it's right. And your return on your account is 100. Your total return, this is really not your return, but your total return is, well, it's 124%. So at the end of the month, it's 24%. So that's the total return on the account. Then what I did is, if this is the previous analysis, assuming the fixed return, right, the 3% per day. And then, so in this case, I plug in instead just the return, just the monthly return, assuming it stays constant, okay, or the total return, which is going to be essentially making 24% per month and adding that cumulatively. And what we get is, in this example, we get $87,000. So just so you know, if you didn't see the previous video, we start with $2,500. Well, we start by taking 3 months to pass 5 Apex trader funding accounts. It could be any trader funding where you get $2,500 risk. This is the analysis I used was from their figures, assuming you use the discounts and all. And obviously, it could take you, as I said, this $2,500 could have easily be $5,000 because it might take you twice as long, right? But I don't think it changes very much if we're talking about, when we're talking about going to 800,000. If it costs you 5,000 or 2,500 or maybe more, right? And this was assuming in 12 months what would happen if you made 3%. You funded 5 accounts and you trade with 3% risk per account, and you did that, with methodical consistency, perfect consistency, and this was the analysis. So that's where we get the initial risk is $2,500, right? And so it's really a $12,500 account. You could also look at it as just take $12,500 if you could do this. Now, what's interesting is, so once we plug in the new numbers, we get $86,000. Now, in the World Cup, there's been returns up to 10 times. And so this is very realistic. I mean, it's not realistic in the sense that, let me reframe that. This type of performance has been recorded as being possible. There's objective evidence that somebody has done it, right? Not in the same way by any means. This is completely different type of the type of trading they would do would be completely different, but this is 863%. This is basically I don't know exactly, but it's about an 860% return, 900%, but it's less than 10 times because 10 times would be 125,000. So this is actually in the realm of possibility based on recorded performance. And if you look at the stats here, one thing that's interesting that I did, I wanted to see what happened if you're losing days. How much bigger could your losing days be? And what I found was, without completely killing your net P&L, your losing day should not be more than 50% of your winning days, your average winning day. So let's say if you plug in 100, you still end up with $450. Assuming you have a high win ratio, right? You still end up with $450 net. But what happens if your losing day is twice your average winning day? Let's take a look at this. You really cut that net profit down to $200, right? So now I've typically traded with a losing day a lot of traders use, their losing days are up to twice their winning days, and we can see that if that's the case, you really got to. What happens if you drop to say a 55% win ratio? You're going to be really negative. Versus if your losing days is, you're still going to be negative if your losing days 50% more. 50% more than your average winning day. However, you're just barely losing. You're on the month, right? So your break even is around 56% probably. Okay, 57%. So, at any rate, so you can plug in these numbers and figure out what you will. One thing that hasn't been talked about is the standard deviation in returns. We're assuming when we looked at scaling, also we're assuming this is something that could be very relevant depending on how you trade. And the standard deviation return is so we looked here at your average winning day and average losing day. But what about your average trade? If your average trade, for example, was $1,000, if you win or lose $1,000, right, and you tend to, and your average profit per trade is $100, then you can see that's your standard deviation. You're either going to win or lose $1,000, but you net $100, and so what that have implications for something like this, obviously, in terms of how this, in terms of the risk that you would need if your average losing day was, so let's see what this looks like, right? So if your average losing day is 1,000, and your average winning day, is 1,100. But you win, let's say, 55. At any rate, this is probably not the time to do this, but the standard deviation returns can, let me refine this. If you only take one trade a day, one or two trades a day, your standard deviation returns can be very high, most likely. Okay, and so that is going to, your average gain may be $100 per day or per day, but that doesn't really show anything about what you're actually swinging back and forth. And many, the markets are very efficient, so many methods have large swings like that. And the problem with that is, many problems with that, but scaling those types of methods are very difficult, and your statistical analysis is very it's very hard to know what might happen if your edge is so small. Then one losing trade could destroy 10 winning trades, right? So we're assuming you have the low standard deviation, and how you would do that. The only way I believe that you can do that, given how efficient markets are, is scalping. This is bar none scalping. Because with scalping, you get to take multiple trades. And one thing I looked at was, I've hit this type of, I've hit very, high win ratio days and stuff. Not this exact performance. This is different. But when I looked at, the times where I had large losses, it was always, it was almost always because I had a large position on, right? And so there's this question of how many trades you should take per day or how much you should risk. But if you want to, the safest way to trade a small account is to trade small. And if you're trading small, you'll need multiple trades to make anything, right? That's the point. The trade small thesis, I wrote about this on my blog at Beyond Backtesting. I call it the small bet versus mentality. It's like the casino. The casino trades small. Now, the problem is, a difficulty rather, is that most trading systems use what I call big bet philosophy, which means they try to capture a relatively few small set of trades that have some sort of a measurable edge historically. The problem is those opportunities that measure that have these that are outliers, so to speak, are infrequent, and so to achieve a net return, the less frequent your trades, the fewer opportunities you have, the harder it is to achieve a given net level return without risking more per trade, right? And rephrase that another way, if you only have 30 trades per year, let's say your system gives you 30 trades per year, and your average profit per trade is, say, a pretty good, maybe $100, maybe $200-300, you can see that system, even if you're assuming maybe making $300 per trade, you're like at $9,000, right? Not a lot. So that's why system traders, really, to make systems really work, you need multiple systems. And ideally, you would have you could trade more trades and reduce your risk per trade. The most sophisticated traders are not trading in that way. They're taking many trades, and the problem is, of course, the difficulty of that is can you find an edge over so many trades? But don't want to belabor that point. But if you're probably taking multiple trades per day, you're probably scalping to achieve this type of consistency, if it's even possible. So we're going to go with this, and I plugged in this number, so we'll go back to this spreadsheet. And this is assuming, right? I don't know if I shared this, but this is assuming your return is 124, right? Your monthly return is 124%. So this is, I think I shared this, and your what that suggests is you could take $2,500 to $87,000, much more, and this is a much more realistic analysis. This assumes your average winning day and losing day are about equal. It's set to 3%, and you manage to win 70% of the days, right? What if you manage to win, let's say this is all equivalent, you manage to win 65%. Okay, this is going to give me 118. So let's see what this looks like. $55,000. So, if you're winning 65 to 70% of days, your expected return is 55 to 80,000. I think I shared that there's been recorded instances of people doing up to 10 times. So this is very much within the realm of possible, even though it is because we're starting with a $12,000 account, right? So it's less than this right here. Is very possible. I mean, there are many recorded instances of doing 400, 5% futures. Very realistic, or more realistic in terms of being in the realm of possible. What if the 3% risk is, as you see, it's pretty small. It is very modest risk. I've been swinging on my trials, and obviously not have many failing as well, but much more than that. Significantly more than that. And if you're consistent, the whole idea is you won't lose more than a couple of days in a row. You shouldn't be losing more than 4 or 5 days in a row, so you could swing a lot more in this, right? And in the trial phase, it probably makes sense to do that. But let's just say that you were risking 5% per account, which with a larger size account would be in the reasonable realm, but very aggressive, right? You might go up to 7%, but you wouldn't want to go any more than 7%. So let's just look at 5%. And at 5%, you gives you $125. I think that was the example we had to start with. And assuming you win 70% of your days, your base return is 1.4%. Now that does yield total return of $258,000. So that's also a little more realistic. It's still very aggressive, particularly in this later phase. You'd probably scale that down. What if you do the 5% risk, but you allow your losing days to be 50% greater? So we'll just say we're going to add it's going to be $187. So 1.25% again. So you can see you're probably at that $80,000 level, 93,000. So this is much more realistic. So it looks like around 80, 90,000 is more realistic. You could take 25 to 90K, assuming you were able to achieve this type of consistency, which again is hypothetical. But many day traders or many traders believe they can do much more than this. And the reason I shared the previous examples, I wanted to share that, look, for myself even, I'm trying to do much more than this. And it just, the whole idea is to try to kind of reframe my thinking into doing less. And that's why I shared it. And this really shows that if you are trying to, on one account, do $300, $400, $500, risking 15, 20% of the account, it's very, probability of a blowout is very high. Whereas something like this, you're risking, your goal is very modest, and it will still, if you're consistent over time and allow those gains to grow, can still produce a very interesting return. I'm a little bit curious what happens, because I do think this is more realistic, or if any type of consistent trading is possible, if any type of profitable day trading is possible, this looks much more realistic. And I want to see what happens if we extend this out, say, a couple months. Let's just see. So, oops, 17, 18. Oops. Oh, that's very. I was like, what in the world? That does not look realistic. Okay, so we get, assuming I didn't blow something up here, we get how to take $2,500 to $350,000 in 18 months. Sounds pretty good. Anyway, I hope you found this. If you found this fascinating, let me know. I gotta close it up here, but thanks.